Welcome to the ACA Alliance Conference in downtown Manhattan. I'm Jane King, and with me is Scott Caraher, the head of senior loans at Nuveen. So welcome, great to have you here.
Thank you for having me.
Let's talk about the opportunity in corporate loans that you're seeing right now. Explain what's been happening in this business.
Sure. So, we've really had, a 2-year period where loans have performed incredibly well, right? If you look at loan performance versus other fixed income asset classes, loans have outperformed by anywhere from 15 to 25%. Why is that? Obviously, the Fed has been raising rates. That's really hurt duration assets. Loans are very unique in that there is no duration embedded in loans. And so loans have not had any negative impact to the Fed raising rates. When you factor in low default rates, loans have performed very well. They're up approximately 10% year to date. And depending on your view on the directionality of Fed policy, we feel very, very good that loans are going to continue that very strong performance in the intermediate term.
Well, that was what I wanted to ask you next, because I feel like we got a consumer price index number in November that was very friendly. The market loved it. Huge rally. Interest rates immediately dropped. Do you think that this is kind of a shift in sentiment, or where do you see the interest rate environment right now?
Sure. Obviously, it's a great thing to have inflation coming down for our economy and for consumers. But if you think about where it is, right, we're still over 3%. The Fed has consistently said their focus is 2%. And investors, time and again over the last 2 years, have been wrong on the Fed. At this point, if you rewind the clock, everybody thought where we are now, the Fed would be lowering rates. And the Fed has held steadfast to that 2% range. And so to go from just over 3 to 2, that's still a lot of wood to chop. And so while it's great to see inflation coming down, we obviously saw a huge rally in the markets yesterday, but you've also seen people like Jamie Dimon say yesterday, we need to really take a break, that he doesn't think inflation just immediately come down to 2. Ken Griffin, the head of Citadel, basically said the same thing. And so there's a belief out there that going from 3 to 2 is not going to be easy. It's going to take time. And so what the Fed has said is we are focused on 2%. And what you saw yesterday with equities rallying, the stronger equities are, the stronger the underlying economy is. It gives the Fed cover to keep rates higher for longer because they are so focused on the 2%. And so what I believe is that if we have the status quo, it's going to take a little bit longer to get that inflation rate down to 2%. What that means in turn for the loan asset class is that the Fed's going to stay higher for longer, and that is going to allow for loan investors, the funds that we manage, to continue to really deliver very significant excess yield, right? So the yield opportunities in our market today are approximately 9.5% to 10%, which is very, very significant. And so if you believe any of that around the Fed and inflation and the timing, what we believe we are going to see is the yield opportunities in the loan market staying higher for longer.
I feel like that last 1%, that 3 to 2% is going to be the hardest one to get.
Yes.
It's like losing the last 5 pounds or something.
Yes, and that's the thing, right? And people were so happy, and they should be happy that inflation is coming down. But again, if you marry where inflation is with what the Fed says, and they've been steadfast in that, you're absolutely right. Getting that 3 to 2 is going to be difficult. And then what does the Fed do against that backdrop?
Yeah, and maybe that will kind of, the realism will settle in on Wall Street over the next few weeks. So talk a little bit about what you do at Nuveen.
Sure. So we manage, we have about a $40 billion leverage finance platform that focuses on loans, high yield, and convertible securities. We wrap these funds, everything from U.S. mutual funds in the U.S. to institutional funds, for investors here in the US, and then institutional funds broadly for international investors, as well as we have a CLO business and a hedge fund business.
Okay. And these are corporate loans?
Correct. Yeah. So these are, exactly, we focus on the broadly syndicated part of the loan market. The average EBITDA in our portfolio is $1 billion and higher. And so these are really companies that are the bread and butter of large cap corporate America. So names like Uber, American Airlines, Burger King, Wynn Resorts, these are large in many cases, publicly traded companies on the equity side that really make up the backbone and the bedrock of the U.S. economy.
And what's the default rate? How does that look right now? And do you expect that to stay consistent?
Sure. So long term, if you go back 20 years, the default rate in the loan market has been approximately 3%. We just ticked above that for the year, so we're just over 3%. And what I always tell investors is, tell me what the economy is doing, and I'll tell you the default rate, right? Because if the economy is weak, defaults are going to pick up. What we believe we're seeing right now, right, which is a softening in the economy, that defaults are going to go into that kind of 4-ish% range. Generally speaking, when you look at recessions over the last 20 years, shallow recessions have default rates that tick up to about the 5% range. What we believe for next year is that defaults are going to be kind of in that 4 to 5% range, which is consistent with a recession, but a shallower recession. And then what I believe is going to happen is as you start to hit that 4 to 5, a little bit of a shallow recession, that's when the Fed will start to lower rates to stabilize the economy. And so that is why we believe that shallower recession is still in the cards for next year.
Okay, very interesting. Thank you so much, Scott.
Thank you.
Thanks.